Hi, Erica here with Unity Insurance and Notary to share with you some tips on how to put your money where your dreams are. So what do you dream in life? I know many people dream about having a great fancy car, being able to live on an island like Jamaica where my husband's from, living in a huge beautiful house, or just having a beautiful family is a big dream in itself. What do you dream of? When you think about that for a second, my dream consists of really helping other people. My goal in life truly is to help people live the best life they can. I truly believe that every day is another day, another opportunity for us to change our life. And so if I can help someone change their life through financial services, I'm here to do that. My dream does encompass many of these things too. I love to have a nice ride, live on an island, and I'm thankful for my beautiful family. But no matter what your dream may be, we all need help and training on how to get to that finish line. And that's what I'm here for. And also too, thank God for phones and apps. Many things are so that you can find your way online. But even so, you need to know how to get that resource. And that's what I'm here to help you with. So for retirement, as you know, as we get older, the cost of inflation, things are going to cost more than what they cost now. And for me right now at 34, my goal is to save $100,000 by the time I'm age 65. But not just that, but accompanied with Social Security and other savings and funds that will help me pay for my retirement. But for this example, we're looking at a goal of $100,000 by the time we're 65, and we have two different families to give you an idea. So this first family is starting at age 30 of saving. If they were to save $22 a week, the total cost of $36,890, but thanks to interest and growth, by the time they're 65, they have $100,000. This other family who waited till age 45 to start saving will have to save $55 a week, a total cost of $57,600 by the time they're age 65 to have earned $100,000 thanks to savings. But in this example, it's assuming a 5% growth rate for that to reach that goal by 65. As you may know nowadays, many banks do not pay 5% interest on our savings. So what vehicles out there could offer that? I'll tell you in a few seconds. So how can I start saving? Yes, definitely paying down our debts like credit card debts and saving, but with couponing, all those kind of ways can start us in saving. You'd be amazed by how much a $10 coupon savings can end up costing you, in a sense of you can put that $10 toward your retirement, and how that will grow over time in years. So it's never too late to start saving. Start now. But as you're beginning to save, it's important to take into consideration the cost of inflation for when you will retire, and tax considerations, because as you may know now, every time you file your taxes, you see ways to get deductions for savings toward retirement, or you may have to pay tax in other kinds of ways, and I'm going to explain to you some ways of how that will impact you. So here we show an example of how $50,000 today would cost us $58,027 in 10 years if inflation is to increase by only 1.5%. And it's the same as you see there for the 20-year mark. If the inflation was to go up by 3% interest rate, $50,000 today will actually cost $67,196 in 10 years. So Erica, what does this all mean? This just shares with you, let you know that the savings you have today, without being in a savings vehicle that offers you interest and increase, it's not going to keep pace with inflation. So what are some ways that can keep pace with inflation? I'm going to tell you. Ways to save. After tax, pre-tax, tax deferred, and tax-free. Now, what do these really mean? And I'll tell you right now. So many of us know about the pre-tax way of savings. That includes 401ks, IRAs through our employers, SEP IRAs if you're self-employed. But other ways, and how I explain this as well to you, is the after-tax strategy. So that is when you put aside a portion, so money that comes out from your your net income that you bring home, and you begin to put into a savings account or CDs. That's considered after-tax savings vehicle. Again, the pre-tax strategy is the 401ks and the IRAs. Those come out through your employer, typically through pre-tax deductions. towards your savings. Tax deferred, that is a savings vehicle like an IRA or a Roth IRA, I should say. How that is tax deferred because it's paid, it's invested into after tax, so not pre-tax. And also an annuity is also in that category of tax deferred savings vehicle. Now the tax-free strategy, as has most people interested, like, how can I do tax-free? That includes permanent life insurance as well as the Roth IRA and annuities. And I'm going to get into that a little bit more deeper. So to kind of follow what I just shared, strategies to save for retirement, there's 4 main ways. The after-tax, that's the private savings accounts we currently have, or CDs. Tax deferred, which is annuities, which I'll go into a little bit later. The pre-tax one most people are very familiar with. That's the traditional IRA, the qualified 401ks, 403b plans, those kind of plans. And then we have the tax-free, where we all want to be in. That's the Roth IRA and the permanent life insurance cash value. But it's not about how much you accumulate for retirement. You also need to factor in taxes on retirement income. So you can accumulate a whole lot of money in there, but when it's time for distribution, what's going to happen? And that's when we go into looking into why understanding your tax strategy is so important. So if you were a farmer, would you rather be taxed on the seed or the harvest? And so when you think about this question, it's pretty deep, I like to say. So the seed. The seed is the actual deposits you begin to make at the beginning of your retirement before it grows thanks to interest and all that. Do you want to be taxed on the seed or the harvest? So the harvest is what has accumulated over your years of saving. So you may have put in only $30,000, but now by the time you retire, it's worth $100,000. Do I want to be taxed on the $100,000 or the $30,000? And really, there is no right or wrong answer. It's really based on how your strategy is. But for me, I'd rather be taxed on the seed up front and not taxed on my larger gross amount. Here's why. So here's comparing the options. The traditional IRA, this is a tax-deferred, a pre-tax option, where you have zero tax on the contributions, right? Because it's coming out pre-tax from your employer. And the Roth IRA is considered tax-free because it's after-tax contribution. So as this is coming from your net income, then you decide to make an additional deposit savings into a Roth IRA. So as you see here, and you'll see in the next here, in the example of being taxed on the harvest, a traditional IRA, when it's time to do your withdrawals, you'll be taxed on the whole amount. So not only that, your contribution, but also the deferred growth. In the Roth IRA, you're only going to be taxed from the upfront, the after-tax contributions, because thankfully with the Roth IRA, tax is deferred, so therefore you're not being taxed when it's time for distribution for your Roth IRA because you paid it up front. So to me, that's paying tax on the seed. So taxation on savings. Again, the 4 main tax strategies for your savings is after-tax, pre-tax, tax-deferred, and tax-free. And boom. And we go on to the next one. So a closer look at tax-free retirement strategies. So permanent life insurance. Now you may say, how can permanent life insurance help me in my retirement? Well, here's how. Because income grows, your cash value grows tax-free, you're able to, through an index universal life policy and also a whole life policy, but I prefer and recommend index universal life because of the flexibility, you have the ability to deposit income through premium payments that will continue to grow your cash value. When it's time for retirement, you can take loans and withdrawals against that can pay towards your retirement, your living needs, or whatever else you may have. That's the beautiful view of an index universal life. Truly, with permanent life insurance, when used smartly, you can be your own bank. I mean, why go and get a loan for a vehicle if I have the savings cash value in my IUL? Just to give you some thoughts and ideas. So that's why I say permanent life insurance is one of the #1 ways to have a tax-free retirement strategy if you start young enough. Now, with the Roth IRA, you have annual contributions are limited and has max income restrictions. So you can look at the max income restrictions online, but typically for a single person, it's around like $127,000 a year. If you reach that max income restriction, you can only deposit up to $5,500,000 a year into a Roth IRA if you're under 50, and they allow you some more catch up if you're over 50 to pay $6,500. But in the end, a combination of the two, meaning a permanent life insurance strategy and a Roth IRA, can be a great way for you to prepare for retirement and have that money savings that's tax-free accessible to you at distribution. Okay, so how does that really work with life insurance? Here it is. Each premium payment that's made, it builds cash value income that's tax deferred, provides an income death benefit if you were to pass on to your beneficiaries. It also offers an optional accelerated benefit rider so that if you were to become disabled or sick or chronically ill, you can always access your life insurance policy income value. And then also cash value that can be used toward lifetime with policy loans and withdrawals. And that's the beautiful part about permanent life insurance, is that cash value you have access to through policy withdrawals and loans. So permanent life insurance can provide a death benefit protection to provide survivor retirement income, cash value accumulation that can be accessed during lifetime to supplement retirement income, and access to policy values in the event of a terminal, chronic, or critical illness. That's the beauty of having permanent life insurance versus term. So annuities. Annuities is a retirement savings choice of many. And now that I know more about it, I'm a big proponent of annuities, and I preach it honestly. Because contract flexibility is one proponent of it. Tax-deferred accumulation of earnings. Annuities funded with after-tax dollars permit tax-free recovery of contributions. But the best part about annuities is what I have bolded and underlined, is guaranteed income for life. So when you complete a contract for an annuity with an insurance company, the insurance company, in lieu of receiving either a single premium, a lump sum, or periodic payments from you, they are taking on the risk of making sure you do not outlive your income or your resources. It's going to guarantee you, because you paid into them for the last 20, 25, 30 years, or you made this big lump sum payment, and they'll continue to pay you monthly or annually based on your distribution option for life. Now, where else can you get that? What's happening? Man, I'm going so good. Okay, we're back. Yay! Okay. There is no other financial product that offers that kind of guarantee to us, like an annuity does. So how are annuities purchased? It's either a single premium annuity or a periodic payment annuity. It can be distributed either immediately, meaning so you deposit a big lump sum. You may be 61 years old, and you want to begin receiving payments that next month. You can do that with an immediate annuity. And with the investment strategy with annuities, it can be a fixed, an index, or a variable. And what that means is the VIX has a guaranteed interest rate that will be fixed across line. The index annuities offers a interest rate that is based on S&P performance, but you will never lose. You always have a great opportunity to gain, so it can be much higher than a fixed. A variable annuity is a little more riskier because you can have a great gain, 12%, or you can be negative 12%, but it's all based on your risk tolerance. So consumer financial concerns, most people always are concerned that they may die too soon, may become ill, or live too long. With annuities, it solves that question of, okay, what if I live too long? Will I have enough money? You can with an annuity. If I become ill, thankfully, thanks to permanent life insurance, you can always tap into that to help pay for your terminal illness or critically ill. And if you die too soon, unfortunately, through permanent life insurance and annuities, your beneficiaries can access to have income as well. So when it comes down to estate planning, and a part is honest, very much so a crucial part of planning for your retirement. Wills is a need. We almost have a will no matter what age you are. Look into trust and talking to a lawyer in regards to that, and building for your family for wealth. Charitable gifts. Oftentimes people want to give to others, like their churches or their nonprofit. You can include that in your estate plan. And of course, life insurance is one of the anchors of your estate plan, and I can help you with that. So, with this presentation about putting your money where your dreams are, consider talking to me in more detail about how to prepare for your future, how to protect your family, and planning for your legacy. So thank you for taking the time to watch this video. This is Erica Woodstock from Unity Insurance and Notary. Please go to Unity Insures DMV